Welcome to Daily Podcast, the future of intelligence. Today, we're diving into something that's reshaping the world of finance, reinforcement learning and its application to portfolio investment.
Oh, this is a game changer. Reinforcement learning, or RL, is basically teaching machines to make decisions through trial and error. And when it comes to managing portfolios, it's like giving the algorithm a crash course in Wall Street.
Exactly. So, instead of relying on those static, rule-based models we've seen for decades, RL algorithms learn by interacting with the market environment. They buy, sell, and adjust strategies based on real-time feedback, like a trader, but without the coffee jitters.
Right? And the beauty of it is that the agent, let's call it the digital portfolio manager, learns to maximize rewards over time. Those rewards? Financial returns. So, it's all about optimizing the portfolio for the best possible outcome.
But here's where it gets really interesting. RL isn't just about following a script. It adapts. Markets change, right? Volatility spikes, trends shift, traditional strategies can get left behind. But RL? It's constantly learning, evolving, and adjusting to new data.
Yeah, and that adaptability is huge. Think about it. RL can potentially deliver better risk-adjusted returns. It's not just chasing profits. It's balancing risk and reward based on the investor's profile. That's personalized investing on steroids.
But, and there's always a but, it's not all smooth sailing. One of the biggest challenges is the black box problem. These algorithms make decisions, but it's not always clear why. How do you explain to an investor why the AI sold all their tech stocks?
Oh, that's a big one. Transparency is key in finance. If you can't explain the strategy, it's hard to build trust. And let's not forget the data hunger. RL needs massive amounts of historical data to train effectively. Not everyone has access to that kind of firepower.
True. And then there's the risk of overfitting. If the algorithm learns the training data too well, it might fail in real-world scenarios. Markets are unpredictable. What works in the lab might flop in the wild.
Absolutely. But despite these hurdles, the potential is undeniable. RL could revolutionize how we approach portfolio management. Imagine a system that not only adapts to market changes, but also tailors strategies to individual risk tolerances. That's the future.
And as research progresses, we're likely to see more sophisticated algorithms that address these challenges. Explainability, data efficiency, robustness, these are all areas where breakthroughs could make RL the go-to tool for investors.
For sure. It's a double-edged sword, but one that's worth wielding. The financial world is ready for a shake-up, and RL might just be the disruptor we've been waiting for.
One of the biggest hurdles with reinforcement learning in finance is that lack of transparency. Investors want to know why their money is being moved around. If the algorithm can't explain its decisions, it's like handing over your portfolio to a mysterious stranger.
Oh, absolutely. And it's not just about trust, it's about accountability. If something goes wrong, who's responsible? The algorithm? The developer? It's a legal and ethical minefield.
Right. And let's not forget the data problem. RL thrives on massive datasets. But financial markets? They're not just complex, they're chaotic. You need years, maybe decades, of historical data to train these agents effectively.
Yeah, and even then, there's no guarantee. Markets evolve. What worked in 2008 might be useless today. So, you're not just collecting data, you're chasing a moving target.
Exactly. And for smaller investors or institutions without deep pockets, that's a huge barrier. The cost of acquiring and processing that data can be astronomical.
But, and this is a big but, if you can crack those challenges, the payoff is enormous. RL has the potential to create investment strategies that are not just reactive but proactive. It's like having a crystal ball, but one that learns from its mistakes.
True. And as algorithms get smarter, we're seeing progress in areas like explainability. Researchers are working on ways to make RL decisions more interpretable. Imagine being able to ask the algorithm, "Why did you sell those stocks?" and getting a clear, logical answer.
Oh, that's the dream. And it's not just about explaining past decisions, it's about building trust for future ones. If investors can understand the logic, they're more likely to embrace the technology.
And let's not overlook the potential for personalization. RL can tailor strategies to individual risk tolerances. One investor might want aggressive growth, another might prioritize stability. RL can adapt to both.
Yeah, and that's where it really shines. It's not a one-size-fits-all approach. It's dynamic, it's flexible, and it's constantly learning. That's the future of investing.
But we're not there yet. There's still a lot of work to be done on data efficiency, on robustness, on making these systems accessible to more people. It's a marathon, not a sprint.
Agreed. But the strides we're making? They're significant. RL is no longer just a theoretical concept. It's being tested, refined, and deployed. And that's exciting.
Absolutely. The financial world is ripe for disruption, and RL might just be the catalyst. It's not without its challenges, but the potential? It's game-changing.
Game-changing is right. And as we solve these challenges, we're not just improving algorithms. We're reshaping how we think about investing altogether.
So, let's break this down a bit. Agents, environments, states, actions, these are the building blocks of reinforcement learning, right? It's like the agent is this little decision-maker navigating a world full of challenges and opportunities.
Exactly. And the environment? That's the stage where everything happens. It's not just physical spaces. It could be a simulated world, a game, or even something abstract like a financial market. The environment sets the rules, throws curveballs, and dishes out rewards or penalties based on what the agent does.
Right, and the agent's job is to figure out how to play the game. It observes the environment, takes actions, and learns from the feedback it gets. But here's the kicker, it's not just about reacting. The agent has to think ahead, strategize, and adapt.
Yeah, and that's where states come in. A state is like a snapshot of the environment at any given moment. It's all the information the agent needs to make a decision. Like in chess, the state is the board, the pieces, and whose turn it is. The agent uses that to decide its next move.
And actions are the moves, literally. They're the choices the agent has in any state. Push left, push right, buy, sell, whatever the environment allows. But here's the thing. Every action changes the state. It's like a domino effect. One move leads to another, and the agent has to keep up.
Oh, and let's not forget rewards. That's the carrot, or sometimes the stick. The environment gives the agent a score based on its actions. Positive rewards for good moves, negative ones for mistakes. The agent's whole goal is to rack up as many points as possible over time.
Which brings us to policies. A policy is basically the agent's playbook. It's the strategy that tells the agent what to do in every possible state. Sometimes it's straightforward, like, always go left. Other times, it's more nuanced, with probabilities and trade-offs.
And that's where the magic happens. The agent isn't just following a script. It's learning, refining its policy as it goes. It's like a chess player who gets better with every game, figuring out which moves lead to wins and which ones lead to disaster.
Take the cart pole problem, for example. The agent has to balance a pole on a cart by moving left or right. It's a simple setup, but it's a great way to see RL in action. The agent starts off clueless, wobbling all over the place, but over time, it learns to keep the pole upright.
Yeah, and that's the beauty of it. RL isn't just about solving one problem, it's about learning how to learn. The agent starts with trial and error, but eventually it builds this internal model of the world. It's like teaching a kid to ride a bike. They fall a few times, but then it clicks.
But here's the thing, RL isn't just for games or simulations. It's being used in robotics, healthcare, even climate modeling. The principles are the same. Observe, act, learn, repeat. It's a universal framework for decision-making.
And that's what makes it so powerful. It's not just about solving specific problems. It's about creating systems that can adapt and thrive in complex, ever-changing environments. That's the future of intelligence right there.
Absolutely. Whether it's balancing a pole or managing a portfolio, RL is all about learning to navigate uncertainty. And as the algorithms get smarter, the possibilities are endless.
Endless and exciting. We're just scratching the surface of what RL can do. And honestly, I can't wait to see where it takes us next.
So, let's dive deeper into how reinforcement learning actually works in portfolio management. The agent, let's call it the digital portfolio manager, is essentially learning by doing, right? It's not just following a set of rules, it's figuring out what works through trial and error.
Exactly. And the environment here is the financial market. It's like this massive, chaotic playground where the agent has to navigate. It takes actions, buying, selling, rebalancing, and then gets feedback in the form of rewards or penalties based on how those actions play out.
Right, and those rewards are tied to financial returns. So, the agent's goal is to maximize those returns over time. But it's not just about making money, it's about balancing risk and reward. The agent has to learn how to make decisions that align with the investor's goals.
Yeah, and that's where it gets tricky. The agent has to explore different strategies, see what works, and then refine its approach. It's like a trader who's constantly learning from their wins and losses, but without the emotional baggage.
But here's the thing, unlike a human trader, the agent can process massive amounts of data in real time. It can analyze market trends, historical data, even news sentiment, and adjust its strategy on the fly. That's a huge advantage.
Oh, absolutely. And because it's learning through interaction, it can adapt to changing market conditions. A traditional model might stick to a fixed strategy, but an RL agent? It's constantly evolving, which is crucial in a volatile market.
But, and this is a big, but it's not perfect. One of the challenges is that the agent needs a lot of data to learn effectively. And not just any data, high-quality, relevant data. Without that, it's like trying to learn a language without a dictionary.
Yeah, and even with great data, there's the risk of overfitting. The agent might get really good at predicting past market behavior, but that doesn't mean it'll perform well in the future. Markets are unpredictable. What worked yesterday might not work tomorrow.
True. And then there's the issue of explainability. If the agent makes a decision, how do you explain it to the investor? The algorithm sold your stocks because it just felt like it? That's not going to fly.
Oh, that's a huge hurdle. Investors want transparency. They need to understand why their money is being moved around. Without that, it's hard to build trust. And trust is everything in finance.
But despite these challenges, the potential is enormous. Imagine a system that not only adapts to market changes, but also tailors its strategies to individual risk tolerances. That's personalized investing on a whole new level.
Yeah, and as the technology improves, we're likely to see more sophisticated algorithms that address these issues. Explainability, data efficiency, robustness. These are all areas where breakthroughs could make RL the go-to tool for investors.
And let's not forget the scalability. Once you've trained an RL agent, it can manage multiple portfolios simultaneously. That's a game changer for institutions handling billions of dollars.
Absolutely. It's not just about replacing human traders, it's about augmenting them. RL can handle the heavy lifting, freeing up humans to focus on strategy and oversight. That's where the real value lies.
So, while it's still early days, the future looks promising. RL has the potential to revolutionize portfolio management, but it's going to take time, research, and a lot of trial and error to get there.
And honestly, that's the exciting part. We're on the cusp of something transformative. The financial world is ready for a shake-up, and RL might just be the disruptor we've been waiting for.
So, let's talk about how RL algorithms can actually learn these complex relationships directly from data. It's not just about following preset rules. It's about the algorithm figuring out patterns and strategies on its own, right?
Exactly. Traditional models rely on human-defined rules, but RL? It's like giving the algorithm a blank canvas and saying, go figure it out. It learns by interacting with the data, spotting trends, and refining its approach over time.
And that's where it gets powerful. These algorithms can uncover relationships that might not even be obvious to human analysts. They're not just crunching numbers, they're building sophisticated trading strategies from the ground up.
Yeah, and here's the kicker, they can incorporate risk management right into the process. By tweaking the reward function, you can teach the agent to balance returns with risk tolerance. It's not just about chasing profits, it's about creating sustainable strategies.
Oh, that's huge. So, the agent isn't just optimizing for short-term gains, it's thinking long-term, factoring in things like volatility and downside risk. That's a game changer for portfolio management.
Absolutely. And it's not just theoretical. Take OpenAI's AlphaStar, for example. It mastered StarCraft 2, a game with insane complexity and real-time decision-making. If RL can handle that, Imagine what it could do in finance.
Wait, AlphaStar? That's the one that beat top human players, right? How does that even translate to portfolio management?
Well, think about it. StarCraft is all about strategy, resource management, and adapting to a dynamic environment. Sound familiar? Markets are just as chaotic. If an RL agent can learn to dominate a game like that, it can learn to navigate financial markets too.
So, you're saying we could train an RL agent on historical market data, and it would learn to buy, sell, and rebalance based on market signals? Like, it builds its own internal model of how the market works.
Exactly. It's not just reacting to data. It's predicting, strategizing, and adapting. And the more data it gets, the smarter it becomes. It's like having a trader who never stops learning.
But, and this is a big but, markets aren't games. They're influenced by human behavior, news, even geopolitics. Can an RL agent really account for all that unpredictability?
That's the challenge, isn't it? But here's the thing, RL thrives in dynamic environments. It's designed to handle uncertainty. Sure, it's not perfect, but it's a step closer to creating strategies that can adapt to real-world complexity.
And if we can crack that, the potential is enormous. Imagine an agent that not only maximizes returns, but also minimizes risk, all while adapting to market shifts in real time. That's the holy grail of investing.
Oh, absolutely. It's not just about replacing human traders. It's about augmenting them. RL can handle the heavy lifting, freeing up humans to focus on strategy and oversight. That's where the real value lies.
So, let's talk about how we actually measure the performance of these RL agents in portfolio management. You mentioned metrics like the Sharpe ratio, maximum drawdown, and portfolio value growth. How do these come into play?
Oh, great question. The Sharpe ratio is a big one. It measures risk-adjusted returns. Basically, it tells you how much return you're getting for every unit of risk. A higher Sharpe ratio means the agent is doing a better job balancing risk and reward.
Right, so it's not just about making money, it's about making money smartly. But what about maximum drawdown? That's the worst case scenario, right?
Exactly. It's the largest peak-to-trough decline in the portfolio's value. You want that number to be as small as possible because it shows how much you could lose in a downturn. A good RL agent should minimize drawdowns while still chasing growth.
Got it. And portfolio value growth is pretty straightforward. It's just how much the portfolio's value increases over time. But here's the thing. These metrics are great, but they're not the whole story. What about the techniques themselves? Like Q-learning or deep Q networks?
Oh, yeah. Q-learning is a classic. It's model-free, so it doesn't need a predefined model of the environment. It just learns by estimating the expected reward for each action in a given state. Simple, but effective.
But when you're dealing with high-dimensional data, like, say, a portfolio with hundreds of assets, Q-learning might struggle, right?
Exactly. That's where deep Q networks, or DUNs, come in. They use neural networks to approximate the action value function, so they can handle way more complexity. It's like giving the agent a supercharged brain.
And then there's policy gradient methods. These are a bit different, right? They optimize the policy directly, aiming to maximize cumulative rewards.
Yeah, they're more about tweaking the strategy itself rather than just estimating values. It's like fine-tuning the agent's decision-making process. And the cool part? You can combine these techniques to create even more sophisticated systems.
But, and this is a big but, these methods aren't perfect. RL is still a double-edged sword. It's got all this potential, but the challenges are real. Like, how do you deal with the unpredictability of financial markets?
Oh, that's the million-dollar question. Markets are influenced by so many factors: human behavior, news, geopolitics. RL agents have to navigate all that chaos. It's not like a game where the rules are fixed.
And then there's the data problem. RL needs massive amounts of high-quality data to learn effectively. Without that, it's like trying to teach someone to drive without ever letting them behind the wheel.
Yeah, and even with great data, there's the risk of overfitting. The agent might get really good at predicting past market behavior, but that doesn't mean it'll perform well in the future. Markets evolve, and the agent has to keep up.
So, while RL has the potential to revolutionize portfolio management, it's not a magic bullet. It's a tool, a powerful one, but it's got its limitations.
Absolutely. But here's the thing, every challenge is an opportunity. As we solve these problems, we're not just improving algorithms, we're reshaping how we think about investing altogether.
And that's the exciting part. We're on the cusp of something transformative. The financial world is ready for a shake-up, and RL might just be the disruptor we've been waiting for. Person one. So, let's dig into this idea of RL agents adapting to volatile markets. You're saying they can spot trends and adjust portfolios in real time? That's wild.
Oh, absolutely. Traditional models? They're like driving with a map from 2010. RL agents? They're GPS on steroids, constantly recalculating based on live traffic. They learn from historical data, sure, but they're built to pivot when the market shifts.
Right, and that's where they shine in volatility. Markets go haywire, and these agents don't panic, they adapt. But here's the thing. How do they actually learn to spot those trends? Is it just pattern recognition, or is there more to it?
It's deeper than that. They're not just spotting patterns, they're building strategies. Think of it like they're playing chess with the market. Every move teaches them something new. Over time, they figure out which moves lead to wins and which ones lead to losses.
And that's where the risk-adjusted returns come in, right? They're not just chasing profits, they're balancing risk and reward. So, if an investor is risk-averse, the agent adjusts its strategy accordingly.
Exactly. It's like having a personal trainer for your portfolio. One investor wants to bulk up, high risk, high reward. Another wants to stay lean, low risk, steady growth. The agent tailors the strategy to fit.
And this is a big but, how do you explain that to an investor? If the agent sells off a chunk of their portfolio and they're like, why? What do you say?
Oh, that's the black box problem. The agent makes decisions, but it's not always clear why. It's like asking a chess grandmaster to explain every move in real time. Sometimes, even they can't.
Yeah, and that's a huge hurdle. Investors want transparency. They need to trust the system. If they can't understand the logic, they're not going to hand over their life savings.
True. And then there's the data issue. RL agents need massive amounts of historical data to train effectively. Not everyone has access to that kind of firepower. Smaller investors? They're at a disadvantage.
And even if you've got the data, there's the risk of overfitting. The agent might ace the training data, but flop in the real world. Markets are unpredictable. What worked yesterday might not work tomorrow.
Yeah, and that's the double-edged sword of RL. It's powerful, but it's not foolproof. You've got to balance the potential with the pitfalls.
But here's the thing, when it works, it's game-changing. Imagine a system that not only adapts to market shifts, but also tailors strategies to individual risk tolerances. That's the future of investing.
Oh, absolutely. And as the tech improves, we're likely to see more sophisticated algorithms that address these challenges. Explainability, data efficiency, robustness. These are all areas where breakthroughs could make RL the go-to tool for investors.
And let's not forget scalability. Once you've trained an RL agent, it can manage multiple portfolios simultaneously. That's a game changer for institutions handling billions of dollars.
Yeah, and it's not just about replacing human traders, it's about augmenting them. RL can handle the heavy lifting, freeing up humans to focus on strategy and oversight. That's where the real value lies.
So, let's tackle this overfitting issue head-on. RL agents can get too good at the training data, right? Like, they ace the simulation but flop in the real world. How do we stop that from happening?
Oh, that's a big one. Overfitting is like memorizing the answers to a test instead of actually learning the material. The agent nails the training data but can't handle new scenarios. And in finance? That's a disaster waiting to happen.
Exactly. So, what's the fix? You mentioned regularization techniques. What does that even mean in this context?
Think of it like putting guardrails on the agent's learning. Techniques like dropout or L2 regularization prevent the model from getting too fixated on specific patterns. It's like saying, hey, don't overthink this. Keep it general.
Got it. And what about the training data itself? How do you make sure it's not too? I don't know, narrow.
Oh, that's key. You need diverse, high-quality data that reflects real-world market conditions. If your training data is all bull markets, the agent's gonna panic at the first sign of volatility. It's like training a pilot only in clear skies. What happens when there's turbulence?
Right. And then there's the evaluation metrics. You can't just look at how well the agent performs on the training data. You've got to test it in unseen scenarios, right?
Exactly. Cross-validation is huge here. You split the data into chunks, train on some, test on others. It's like a dress rehearsal for the real thing. And you've got to use robust metrics, Sharpe ratio, maximum drawdown, stuff that reflects real-world performance.
And this is a big, but even with all that, markets are unpredictable. You can't simulate every possible scenario. So, how do you prepare the agent for the unknown?
Oh, that's the million-dollar question. You can't, not entirely. But you can build resilience into the system. Teach the agent to handle uncertainty, to adapt on the fly. It's like giving it a survival instinct.
And then there's the technical side. Building these systems isn't exactly a weekend project, is it?
Oh no, it's a massive undertaking. You need expertise in software engineering, data science, financial modeling, the whole 9 yards. And even then, deploying and maintaining these systems is a beast. It's not for the faint of heart.
So, is it worth it? I mean, with all these challenges, why even bother with RL in portfolio management?
Oh, absolutely. The potential is just too big to ignore. Imagine a system that learns, adapts, and evolves with the market. One that can handle volatility, tailor strategies to individual risk profiles, and deliver superior returns. That's the future of investing.
But we're not there yet, are we? It's still early days.
Yeah, but the progress? It's incredible. Every challenge we solve gets us closer to that future. And honestly, I can't wait to see where this takes us.
Same here. It's not just about better returns, it's about smarter, more adaptive investing. And that's something worth chasing.
Chasing, and maybe even catching. The financial world's ready for a shakeup, and RL might just be the disruptor we've been waiting for.
So, let's talk about this adaptability of RL agents in portfolio management. They're not just static, right? They're constantly adjusting to market trends and investor preferences. That's a huge leap from traditional models.
Oh, absolutely. Traditional models are like driving with a map from 10 years ago. RL agents? They're GPS on steroids, constantly recalculating based on live traffic. They learn from historical data, sure, but they're built to pivot when the market shifts.
Thanks for joining us on this deep dive into the future of portfolio management with reinforcement learning. It's been a fascinating conversation, and we can't wait to see where this technology takes us next.
Absolutely. Thanks for tuning in, everyone. Until next time, keep exploring the future of intelligence.